Every single stock pick that blew up in someone's face had one thing in common. The buyer had no idea what they were actually paying for. We're not talking about bad luck here. We're talking about a systemic, repeatable mistake that costs everyday investors billions of dollars every single year. The concept sounds almost insultingly simple, but the margin of safety is the single most powerful idea in the history of investing. Benjamin Graham introduced it decades ago, and Warren Buffett called it the 3 most important words in investing. Yet somehow, most people buying stocks today have never even heard of it. Think of it like buying a house you believe is worth $500,000, but you only pay $350,000 for it. That gap, that cushion, is your margin of safety. And it's the difference between sleeping at night and staring at the ceiling at 2 a.m. and watching your portfolio bleed. The problem is that markets are emotionally driven machines, dressed up in spreadsheets and business television. When everyone is excited, prices float up past any reasonable valuation, and the crowd tells itself a story about why this time is different. Spoiler alert, it never is. Remember 2021? Stocks with 0 earnings were trading at valuations that required you to believe the company would dominate its entire industry for the next 30 years just to break even. People weren't buying businesses, they were buying lottery tickets with a Bloomberg terminal. The painful irony is that the more exciting a stock feels, the less likely it is to offer any margin of safety. The stocks that make headlines, go viral on social media, and show up in your group chat are almost always the ones priced for absolute perfection. And the market has never, not once, delivered perfection consistently. Here's the misconception that needs to die. A cheap stock price does not mean a margin of safety exists. A stock at $5 with a true intrinsic value of $2 is actually dangerously overpriced, while a stock at $150 with an intrinsic value of $300 is the screaming deal hiding in plain sight. The calculation itself doesn't have to be intimidating. You're essentially asking what this business would be worth to a private buyer who knew everything about it, and then demanding to pay significantly less than that number. Most professionals suggest a discount of at least 20 to 30%, and in uncertain or volatile sectors, you want that cushion even wider. History is ruthlessly consistent on this point. The investors who survived every crash, 1987, 2000, 2008, 2020, were not the ones with the best stock picks. They were the ones who never overpaid, because a wide enough margin of safety means even a bad outcome doesn't destroy you. There's also a behavioral element here that nobody talks about enough. When you buy with a margin of safety, you actually become a calmer investor. You stop panic selling at the bottom because you already accounted for things going wrong. The bad news was already priced into your entry. The practical process is straightforward. Estimate intrinsic value using discounted cash flows, earnings multiples, or asset-based approaches, then simply refuse to buy unless the market offers you that meaningful discount. It sounds rigid, and it is that rigidity is the entire point. Position size matters just as much as the calculation itself. Even a stock with a massive margin of safety can hurt you if you bet the entire portfolio on it. So the discipline of sizing your positions conservatively is what separates the practitioners from the gamblers. At its philosophical core, the margin of safety is really just an acknowledgement of humility. It's admitting that you could be wrong about the business, wrong about the timing, and wrong about the economy, and still surviving anyway. That kind of structured intellectual honesty is what compounding wealth actually looks like over decades. You don't need to be right all the time. You just need to make sure that when you're wrong, it doesn't permanently damage the portfolio. Discipline, sizing, and consistency, those 3 things, applied patiently over years, will outperform brilliance and conviction every single time. And if you're ready to apply that same disciplined, process-driven thinking to building real wealth through real estate, contracting projects, or finding the right lending partners, check out our links in the description below, and let's get you started.